Hey everybody, Chris Englebert with Englebert Financial Advisers in Allentown, Pennsylvania with the weekly Rotella QCast update. We are talking about how to communicate with your advisor about risk. And we think this is an extremely important episode because there's been a lot of things going on out there, especially the way we started January of 2022. It was brutal. Both stocks and bonds declined right off the bat. And had a rather sharp decline. At one point, the S&P 500 was down 10%, the NASDAQ was down 15%, and the Russell 2000 was down 20%. Not a great way to start out January, but that's what happened. And lo and behold, we did have a nice bounce, and the S&P 500 closed down only about 5.6% for the month. But again, bonds were also down due to rising interest rates. Now, if you caught our market comment from a couple of weeks ago, we have our outlook for 2022. You might want to refer back to an earlier video on that. But I want to talk today about how you really need to communicate and understand what's going on out there in the stock market and bond market, because we did get some calls. I mean, people were panicked. There was news out there. Russia was going to invade Ukraine, the Fed's hiking interest rates, and there was a sharp stock market sell-off. And if you've watched our other videos, especially last week, the first of the month video, we talked about how many of our risk indicators were greatly compressed to levels we haven't seen since March of 2020 when the pandemic first started. But what I want to talk about is communicating. I want to give you 3 tips today, or 3 thoughts on how to communicate with your advisor. Because what ends up happening is nowadays people can look at their account literally every day on an app on their smartphone. They can dial it up on their computer. It's not like the old days, and people don't realize this, but in the 1980s, Japanese brokerage firms did not put prices on their monthly statements. People had no idea if their accounts were up or down. Well, nowadays, we have people that can be hyperactive. They can literally look at their account 5, 6, 7 times a day, and it basically drives them crazy when they see the fluctuations going on. So what do we want to talk about? The 3 tips and what you want to communicate with your advisor about is what is the time horizon for this money. And what we mean by that is if this is retirement money and you've got 25 years of retirement, you should not care about what's happening in the stock market. And if you're a younger person, you should actually hope for a rather sharp pullback in the stock market so that either through your 401k or your IRA, you can dollar cost average down at lower prices, something that's very beneficial in the long term. So what is the length of time as far as how much time you have with this particular money? Now, one of the things that we do, and we're very aggressive doing this, is that if you're retiring or you have a child going to college, we lock that money down 6 to 9 months before the event happens. So for example, our son is going to be going to college next fall. In January, the 1st of January, we took his entire 529 plan and we moved it to cash because we want to make sure that money is there. We had a couple of teachers that are retiring in June of this year. We did the same thing. First week in January, moved their 403B plans to a safe money market fund because we want to make sure the money is there when you walk out the door. So if you have a short time horizon, obviously you want to be very safe with the money and don't have fluctuations. But if you have a longer term time horizon, obviously you have more time to be in the market. Again, the second point we want to make is how much money do you have in the various risk buckets? So we have a lot of clients who have an individual or joint account with us. They're trying to make more money than what they're getting in a savings account. So we have that money in very safe or secure investments that are yielding 1, 2, 3, 4%. Now, some of those investments went down, but for the most part, those accounts are flat or actually up so far in the month of January, because even though interest rates went up, they were not as affected by that because they had what's called short duration investments. So, that's what I call the safe money or the low risk bucket. Then you have a bucket medium risk where you may have a combination of stocks and bonds. Obviously, those declined in the month of January. Then you may have a higher risk bucket where you're really trying to triple or really make a lot of money over the next 5 to 10 years. Now, how those risk buckets act in the market tells you obviously how much risk is out there. And where we see people get in trouble is that they may have a large 401k, maybe $1 million, and they're 2 years from retirement, and they literally have 90% of that money in a stock market. And all of a sudden the stock market goes down 10%. 10% and they lost 100 grand in January. You should be talking to your financial advisor about what your risk buckets are and how much money you have in each of the risk buckets out there. Third thing is you've got to separate your emotion from your money. Many times people see this and they're like, oh my God, I just lost a half a car, or oh my gosh, we just lost the equivalent of half of our house, whatever the case may be. Obviously, if you have a lot more money, you have $1 million, you go down 10%, that's $100,000. Now, all money is important to everybody, but at the end of the day, you got to control your emotions, because where we've seen the biggest loss for people is not by having all their money in the stock market and the stock market's going down. Where we've seen the biggest loss in my career for people is they sell out at the bottom. Stock market starts to go down. They call me up. I can't take it anymore, Chris. Get me out now at any cost. They get out of the stock market. They never get back in. Basically, what they've done is they've locked in that loss and they'll never recover from that disastrous decision. So when the markets decline, don't panic. I've always had this saying my entire career: you never want to be too bearish, which means stocks going down, and you never want to be too bullish where you think stocks are going up forever. You've got to manage your risk. You've got to have different buckets of risk, and you've got to be able to emotionally sit there and say, okay, where am I in my career? Where am I in my retirement? And how much money do I have in order to meet my goals? Then when the media is out there, stock market declines by 500 points, or you see a CNBC special, which you can always tell is kind of the bottom of the market when they do at night, markets in turmoil. It's a very good contrary indicator. You won't panic. You won't get upset. You'll be much more reasonable. And at the end of the day, you got to remember, your advisor does not control the investment markets. I kind of wish I did, but I don't. And what I try to do is I try to put my clients in the best position to make money. But what happens is sometimes we run into a tsunami of news, negative news in particular, and things happen in a short period of time and your account goes down. However, over my career, having a long-term investment horizon, controlling the amount of money you have in each of your risk buckets, and not getting emotional is a recipe for success and a long-term recipe to make money in investing. So that's all we have this week for Rotella's QCast update. We'll be back next week. We'll talk to you soon.